So the chapter 2 basically talk about how are you going to record the business transaction into a journal entry. Okay, so when you see a business transaction happened, you know how are you going to put those one into a journal entry, which one goes to debit, which one goes to credit. And then when you finish the journal entry, because you already set up all those accounts, then you know that how are you going to put those numbers into T account. The T account is, for example, when you start a business, you have been set up a cash account, right? And then when you spend some cash to purchase some office supplies, that you use your cash. So the cash will be affected. Then the T account is kind of summarized all the numbers or all the business transactions under each accounting account. Now we're going to take a look at this business recording together. Now, for example, this is the same examples we used for Lisa Hunter's environmental consulting business. Transaction number 1, starting the business. So Lisa invested $250,000 cash to begin her business. Now we need to record this transaction. Everything related to the business is easy to understand, right? So because if it's anything related for business, office supplies, anything recorded as a inventory purchase or services sold to customer or products sold out, all these kind of things to relate to the business. And there's only 2 different transactions you need to remember. It's also included in your business transaction. Is first of all, the owner investment that will affect your equities account. Okay, so investment. And the second is withdrawal. Okay, so if the owner, Lisa, withdraw cash from the business account, that is a business transaction as well. So only those 2 sides you have to memorize it. One is investment, the second is withdrawal. Those will affect the business transaction. Okay. Now, first, when they invest $250,000, we know that if there is a investment, so the cash will be increased, right? I'll make it smaller. Okay. So we know that the money, $250,000, come into the business, so our cash will increase. Now it's under assets, cash will plus $250,000 because the cash increase. In the meantime, because it's the capital, because the owner put more money in, so our capital, like owner's equity account, increased $250,000 as well. So when you do a dual entry for accounting records, this is how you record these transactions. We debit cash because cash increased. We credit our capital because we know that the equity account increase goes to credit. Okay, do you remember that hand sign? I sent it out in the video. The hand sign shows you if it's assets increase, it goes to debit. Assets decrease, goes to credit. Equity increase goes to credit. Equity decrease goes to debit. So in this specific questions, we debit or cash, credit or capital. Now when you goes to the T account, this is a ledger account. We also call it a T account because it's like T, right? We listed all those accounts name, so like cash, and then we create for capital. So we need capital. Now we debit $250,000 on April the 2nd, and April the 2nd because our capital increased on credit side. So we listed on the credit side. T account, the left is debit, the right side is credit. So this is here you go. So this is a very good analysis, which just shows increase debit under assets, decrease credit. Liability increase under credit, decrease under debit. Owner's equity is exactly the same as liabilities. Increase under credit, decrease under debit. Owner's withdrawal is different. If you withdraw money, which means your withdrawal increase, the withdrawal increase goes to debit. Withdrawal decrease goes to credit. Revenue increase under credit. Revenue decrease under debit. Expenses is vice versa. Increase under debit, decrease under credit. So you have to memorize this so you will be able to do the journal entry. Remember this whole thing? You memorize that, okay? Now we move on to our transaction number 2. We spend money to purchase a land. Spend money, which means your cash decrease because you took money out, right? And you purchase the land, which means your land increase. Land is under asset. So you will see when you see accounting equations, assets, cash decrease $100,000 and land increase $1,000. Because there's on the right, the asset is always happened on the asset side. So it's nothing changed on the liabilities and owner's equity. Because it's minus cash plus land, so there's no change, right? There's no effect on the assets account. Now, when you record it to the journal entry, we debit land because land increased. We credit our cash because cash decreased. When you put into your T account, we put $100,000 on the credit side because it's decreased, and put the land on $100,000 on the land debit side because it's increased. Okay, so far so good. Any questions? No. So we keep going. We keep going with spending. We didn't spend money because we purchased the office supplies on account. That means we didn't really pay off the money. We actually put as account payable, right? Now, office supply, like stationeries, books, papers, whatsoever, all those are under assets. So when you purchase more assets, so your assets increase. Now, in the same time, because we didn't spend our money, we spend our liabilities. Our liabilities increase. Account payable will increase $7,000. When you need to do a journal entries, we always remember, right? You debit your office supply because your assets increase. You credit your account payable because the liability increased too. This is the total amount you will need to pay back in the future. So when you do a journal entry, it's like debit assets, credit your liabilities. When you move on those numbers, this is office supply is a new T account number, right? It's the T account. So you create a new office supplies and you create account payable. You put those numbers onto debit and put numbers into credit. So that is the liabilities come out. Now we're earning of service revenue. That means we make money. We realized the revenue. What we need to do, remember the revenue. When the revenue increase, you put it under debit side or credit side. When revenue increase, goes to debit side or credit side.
Credit side.
Perfect. Yes, so it's under credit side. So when you see this accounting equations, when you put into your journal entry, you know that your cash increased because you sell your service, right? Your customer paid you $30,000. You make that money. So your asset increased $30,000. And then your revenue increased too. Revenues is under owner's equity account. When the increase goes to credit. So you credit your service revenue. And when you put into a T account, $30,000 on the credit side. Okay. Now transaction 5, earning of service revenue on account. We sold services to a customer, but the customer didn't pay me. Okay. The customer saying that I'm gonna pay you in a month. So that is account receivable. We didn't receive the real cash, but we do receive a promise. The promise is the customer gonna pay me in a month. So account receivable is under assets. We're gonna talk about in your level 2 course about unconnected account receivable. even though this is $25,000. But after 1 month, are you 100% sure you're going to receive $25,000 back? No, right? There probably going to be amount that you cannot receive back. Then we're going to talk about it later, not today. So under assets, account receivable increased $25,000. In the meantime, we sell our services revenue. So we credit service revenue. When you go to your journal entry, with debit, account receivable, credit, sales revenue. Now, move on to 6, 7, 8. If you still remember from our first lecture, 6, 7, 8 are all expenses. Those are like office rent. This is of course related to your business, right? Because you have to rent the office. This is something related to your business. Employee salaries. You have your front desk. You probably have accounting person. So those has to be the employee. You need to pay salaries to them. And then the utilities, the power, energy, heat, all those you need to pay. So those are expenses related to your business. You need to record a journal entry for this business transaction. Now, when we paid off, that means you took some money from your account and pay off those expenses. Then when you need to do a journal entry, you credit your cash because your cash decreased, right? And then you debit your expenses. Remember the formulas? Expenses increase goes to debit. So that is how this journal entry looks like. But normally we simply put into one. So you have like rental expenses, salary expenses, utility expenses, and then credit your cash. That means you spend that much money to pay off those expenses. Now, what if we didn't pay through cash? We paid through account. That means account payable. Okay? We need to pay in the short period of time. So this is, we'll have account payable. This is we paid off account, right? So the business paid $5,000 on account payable, which we owe them from the transaction 3. So that means our cash decreased $5,000 and our account payable, because we paid off a part of the account payable. We paid off part of the liabilities, which means our liability decreased. If the liability decreased, it will go to debit. Okay, so when you go to journal entry to record that you spend some cash and pay off your liabilities, you're gonna debit account payable, credit your cash. Okay, that means you spend some money and reduced part of your liabilities. So that is how you record the numbers into a T account. Now, transaction number 10, the home remodel paid from personal funds. They will let you know that if it's for personal. If this is the office remodel, then it's related to your business. Right? You spend money, probably debit, credit your cash, debit your home renovation expenses. But because this is a home remodel, it's for personal use. So there's nothing to do with your business. You do not need to record for journal entry. 11, connection on account. On April 27th, the business received $15,000 cash from one of the clients. So we received this money, which means our cash increased and our account receivable decreased. Account receivable is the other people owe me money, and now they paid me part of the owing. So I record this into a journal entry. With debit cash increased $15,000, or account receivable decreased $15,000. That is how it affects your journal entry, and you put the number into a T account. Now the last transactions, withdrawal of cash. So Lisa Hunter at the very beginning, she invests money. So we increase our capital, right? Now, right now she withdrew the $6,000. This withdrawal will be recorded as cash decreased because the money has been taken off. And then our owner's equity increased. no, owner's equity decreased because the money has been taken out. So this money, the equity account decreased. We have to record it under debit. But in the other way, when you remember withdrawal, if you increase your withdrawal, it goes to debit, right? If you decrease the withdrawal, it goes to credit. So that's why we debit the withdrawal and then we credit our cash. So we put the money into the T account, and that is the way how you record the business transaction. And that is the major thing for chapter 2. Any question before we move on to chapter 3? Good. Okay. So if you ever had a little bit confused about which account goes to what, read through the chapter because they give you a very good detailed explanations for each transactions. Okay. Now we're gonna quickly move on to our chapter 3. Chapter 3 is talking about adjusting process. We know that the accounting cycles had recording business, recording journal entries, and put into a trail balance, and then do the adjusting. So this is on step 5. We're going to do a journalized and post adjusting entry. Okay. Now, why do we need to do adjusting entry? Because the time period, okay, the time period assumptions. What that mean? The time period assumptions ensures that accounting information is reported at a regular interval. It defines that the accounting period and interacts with the revenue and expenses recognition criteria to underline the use of accrual. We're going to talk about so many different special account, like prepaid insurances expenses account, unearned revenue account. So we're going to talk about that, and then we'll have a better understanding. The accounting period for most of business is 1 year. Sometimes some of the business will use the calendar years, which run January 1st to December 31st. But quite a few business are not using those fiscal years. They are not using calendar years, you use fiscal years because mostly if it's the low point in business activities, they probably have an ending year on that time. For example, quite few business are using June the 30th as a ending period. Okay, so when they talk about the ending period, it doesn't always mean the December 31st. It depends on the business. Interim period can be presented to support decisions on monthly, quarterly, or semi-annual period are the most common one. Now, recognition criteria for revenue. Recognition. The revenue recognition criteria, it states that revenues are recorded when earned. Okay, so revenue is earned. In most cases, when the business has delivered a complete good or services to the customer. So we have this, that means by earned, good delivered or services completed, or contractual agreement has been made. The amount of revenue recorded equals the cash value of the goods or services transferred to the customer. Now, we have to emphasize that revenue is earned when the business has delivered all those goods and services, right? But revenue recognition is not directly related to the cash. So we see, we'll have examples. So what do you mean by revenue recognized that not connected to the cash received? See Dr. House, Doctor, remember that famous movie or famous episode? Dr. House, he performed 3 successful surgeries during the month of December. The provincial insurance plan was billed a total of $30,000 on December 31st. The doctor didn't receive payment for his service until February of the next year. According to this revenue recognition criteria, when should the doctor recognize the revenue? Is December or February? Anyone knows? Dr. House performed surgeries on December. And then he billed the insurance from the provincial insurance department for $30,000 on December 31st. He didn't receive that money until the next following year's February. So are we going to recognize the revenue on December, or we're going to recognize the revenue on February?
December. On
Perfect.
February.
Yes, exactly. So the answer is December, as that is when he performed the surgeries, right? So that is the time he performed the surgeries. That doesn't mean that he has to receive the money so he can claim. That is the cash accounting. Well, we're talking about accrual accounting. We're going to talk about this. And then I think we talk about, oh yeah, I mentioned it in chapter 2. So it's not cash related. Now, recognition criteria for expenses. The matching objective directs accountant to identify all expenses incurred during the accounting period. We measure the expenses and match the expenses against the revenue. Okay, so expenses examples including sales commission with a natural link to revenue will be matched against the revenue of the period. Other expenses like rent are very hard. It's not easy to link with a particular sales. Okay, so that's why we need to do adjust. So because of this, special journal entries, we call it adjusting entries, must be recorded to ensure that all revenue and expenses for the accounting period have been properly recorded. So what that means is when you purchase some insurance at the very beginning of the year, we do not see very beginning of the year. Say you purchased your car insurance for a whole year on October 1st. Okay, so you already spent that money. Those are the insurance expenses, but it never happened. Even though you spent money, but those insurances hasn't been happened. So till December 31st, how many months has been happened? 2 months. So you have to recognize those expenses, which is recognized. Okay, so that is how this adjusting interest works to affect your financial statements. We're going to see examples on that. Now, why can we wait to record transaction until the cash comes in or the cash goes out? That is accrual basis business accounting and cash basis accounting. Oh, so it's not from chapter 2 actually, chapter 3. So we basically focus on accrued basis accounting records. To measure the income, business must apply accounting principles and concepts such as accrual basis accounting, the accounting period, the recognition criteria for revenue expenses. Now in accrual basis accounting, the accountant enters the transaction when the business performs a service or incurs expenses. It has nothing to do with the cash. So no matter the cash has been received or paid, we record the transaction. Accrual basis accounting provides more complete information. Only very, very small business with a cash basis accounting. In cash basis accounting, cash receipts are treated as revenue. Cash payment are treated as expenses. But normally in nowadays, we basically use accrued. So this concept used in accrual-based accounting are the accounting period, the recognition for revenue expenses, and the time period assumptions. Prepare adjusting entry. What is adjusting process and why is it important? Adjusting entry assign the revenue to the period in which they're earned and expenses to the period in which they're incurred. There need to measure properly the period's income and the income statements and bring related assets and liability accounts to the correct balance for the balance sheets. Now, this has been illustrated into here. Now, so you can see clearly the types of adjusting entries. Wait, before I wanted to explain this exhibit. Now, Oh yeah, that's okay. Okay, so adjusting entries can be divided into prepaid and accrues. Okay, so prepaid including prepaid expenses, amortizations, unearned revenue, and accrued including accrued expenses and accrued revenues. We're going to talk about each in detail. So prepaid type adjustments, like on the left side with orange, these are needed when the cash transaction occurs before the related expenses or revenues recorded. The examples I was given for insurance expenses, right? Those are prepaid type. Accrual type are needed when the cash transaction occur after the related expenses or revenue is recorded. That's accrued in like interest. So we'll have a detail for each one. Now, prepaid expenses. Those are very important. Okay, so for this special journal entry, it's gonna go with you for whole accounting earnings. You will see all those all over. Now, the prepaid expenses or deferred, it requires adjustment because the cash is paid in one period, but the resources is not completely used until a later period, like insurance. You paid insurance for a whole year at the very beginning, but you never use it, right? So the expenses never happened until you use it after a certain period. Now the entry you need to record the payment for the prepaid insurance expenses will be you decrease your cash because you spend the money to pay for that prepaid insurance. Prepaid insurance is under assets account. So you debit your prepaid insurance and credit your cash. We'll see the examples from there. May 1st, 2019. HEC purchases an annual insurance policy for $3,600. Now the journal entry will be recorded, debit or prepaid insurance, credit, cash. Now after 1 month passed by, we have to recognize the expenses because it become realized, right? So this 1 month has to be 3,600 divided by 12. So that is 1 month happened. We record it as our debit insurance expenses and credit or prepaid insurance because the happened, so it's decreased. Then we realize the expenses, which is increased. So that is how you record it when the prepaid insurance examples. Now, we will prepay insurance examples when you have that. We put those one into a T account. That's exactly what we did for chapter 2. So you open account for prepaid insurance that is under assets. Okay, so we spend $3,600 and on May 31st, after 1 month, we realized 1 month's insurance expenses. Now we move that 300 insurance expenses under expenses account. So that is how that prepaid insurances work. Now, supplies examples. Supplies example. On May the 2nd, 2019, HEC purchases supplies for $1,500 cash. Now, this is the one we just went through from chapter 2 examples. We debit, supplies, credit, cash. Okay. Now, after 1 month, a physical count of the supplies indicated that there are 1,000 still remain. We're still on hand. We hold that $1,000 supplies. Now we need to, which means we'll be used 500 supplies. Now we need to record adjusting entry because end of the month of May, 500 has been used. Remember that policies we talk about revenue and expenses realized revenue. We need to realize that, right? So we debit our supply expenses, credit our supply. So decrease our assets, we realize that supplies expenses. So that is how that works for the supplies. Now similar, we put this into 2 different T accounts. Office supplies under assets account, we realized $500 and the $500 under expenses. Amortizations. Amortization is another different account. Those are the allocation of the costs of a capital assets, except the land. very important. Land, you do not need to amortize it because you're not using it actually. So amortization is very similar to the prepaid expenses in that an asset is recorded when the plant or equipment is acquired. The assets is expensed as it's used. Now, the major differences is that prepaid usually expire within the year, while plant and equipment assets remain for a number of years, like 15 years, probably 25 years. It depends. So when there is amortization, when you purchase the equipment or when you purchase the plant, what are you need to do for amortization expenses? Examples on May 3rd, 2019, we purchased a furniture for $45,000 with expected life of 5 years. So we record this purchase is debit or furniture because it's assets. Now credit cash because we spend cash. Okay, so now a portion after 1 month, the furniture's cost is transferred from the assets account to amortization expenses. Now we know that is 5 years. So we use $45,000, that is the original costs, divide by 5 years. So the amortization cost will be $9,000 per year because it's only past 1 month, right? So we use $9,000 per year divided by 12 months. So $750 per month for amortization expenses. We have to realize that amortization expenses per month with $750. So when you realize that, you debit your amortization expenses and you credit accumulated amortization. Accumulated amortization is instead of, because you can when you record the amortization, you're not just deduct your assets value. So that's why we create a accumulated amortization account instead of directly deduct the assets value. Okay, so that is how that works. We use accumulated amortizations. Now that goes to account to account. Account to account has a company account, so always related together. For example, accumulated amortization corresponding to amortization expenses. Okay, so they're always a company account. A normal balance opposite that of the company account. Accumulated amortization is counter account to property, plant, and equipment assets. Now, so simply just memorize it if you cannot remember that. When you see amortization expenses happened, you always credit your accumulated amortizations account. Now, when you have these examples, okay, after posting amortization, the related accounts are as follows. Our assets, we purchased $45,000 on our debit, and our cash decreased $45,000. Now, our accumulated amortizations after 1 month were recorded on their credit side, $750. In accordance to accumulated amortizations, you go with amortization expenses with debit $750. Now, the resulting value of the furnitures was before $45,000. We deduct $750. Now, our furniture's net value will be $44,250. So that is how this amortization expenses work. See, when you prepare a balance sheet, after 1 full year, you have to list your original expenses for the property, and then you also have to list the accumulated amortizations. Then you will have your net PPE amount. But mostly, if you take a look at the public accounting's financial statements, you probably won't see all those detailed calculations, but they do put under a notes. So if you cannot see this under the balance sheets, they sometimes just list it as a notes to see that how they calculate this net value for the PPE. Now we move to our unearned revenue. Unearned revenue is a liability, right? We have talked about this before. Unearned revenue is when a business receives cash in one period, but does not earn all of it until the next period. So like a catering business, you receive a cash to prepare a catering for the following month. So the cash is already recorded, but is the revenue or the expenses happened? No, right? So we record it as unearned revenue. That is obligation. So unearned revenue is non-binding because business owes the customer good or services. How to do a journal entry to record unearned revenue? The example shows that HEC received a cash of $3,000 on May 20th for a customer for 30 days project. So this is for 30 days. Now we record the first cash received. We debit or cash and credit unearned revenue. Okay. Now we need to adjust it when the time passed by. So during the last 10 days of the month, earned 1/3 of the $3,000, which means we earned $1,000. So to better understanding, the company, if you're catering business, right? The customer paid you $1,000 for the following month's business events. They said that the $1,000 is for 10 days. For 10 days. Now, from the first day to the 5th day, you realized $100 per day, right? $100 per day. So you realized $500 after the 5 days passed. So exactly as these questions. So if the 10 days passed, you have earned $100. Then you have to recognize that service revenue was $1,000, which is increased, and your liability is decreased. We debit our unearned service revenue, decrease at $1,000, and realize the service revenue $1,000 under credit. So that is how you recorded unearned revenue. Now the similar things, we put those unearned revenue account into the T account. Under the very beginning, we spend cash, and then we credit our unearned revenue. Then after 1 month, we recognized $1,000. So we debit $1,000 with our unearned service revenue balance with $2,000. Then your revenues, you have your service revenue recognized on credit, $1,000. Then your total. This total is for the whole company's business transaction. Okay, it's not just for this one. Now the current non-business amount still $2,000. A total account business for $3,000. Now a correct revenue amount will be $1,000. So that is for unearned revenue. Now accrued expenses. Accrued expenses are expenses that are incurred by the end of the period, but will not be paid until a later period. The adjusting entry record expenses and a liability. For example, salaries. Okay. See, if you're working till December 31st, you're supposed to get paid. But unfortunately, December 31st is a Saturday, so you're not going to get paid on that day. Then they have to pay you on the next payday, which is maybe January the 2nd. So this December 31st, when they record it, is the employees already provide their services. You're supposed to pay the salary, but you haven't paid yet. That is accrued expenses. Okay. Accrued expenses always create liabilities. Oh, here we go. This is the example. So HEC pays 2 employees a bi-monthly salary of $4,000 in total on the 15th and the last day of the month, so 31st. But unfortunately, May the 31st is a Saturday. Okay, so the employee will receive their paycheck on Monday, the following June the 2nd. We need to match the salary expenses to the period with a journal entry on May the 31st. So we debit our salary expenses, credit our salary payable. So that is increase the liabilities. Okay. So salary expenses, credit, salary payable. Now, after that, you paid off on June the 2nd. We decrease our salary payable. That is our liabilities, right? So we decrease our liabilities. We spend our cash to pay off the liability. So debit your salary payable, credit the cash. Accrued revenue. Accrued revenues are revenues have been earned because the good or services has been delivered, but not yet connected. Now the adjusting entries to record this accrued revenue is like this. Now HEC is hired on May 15th to provide monthly service for $3,000 per month, with the first payment to be received on June 15th, service is provided from May 15th to May 30th. We need to make adjustment. So we debit for the 2 weeks of revenue, right? We recognize the revenue, always being credit service revenue. Now we debit our account receivable. So always, if there's revenue, if their sales happened, always recorded as service revenue. Now till end of the May, that is the end of the May. So that's just recognize the 2 weeks of the revenue. Now when you put into your T account for Sumner's, we put account receivable $1,500 and revenues on the credit side. Okay, so leave your balance. Adjusting interest never involve the cash account. So if there's a cash account, you do not need to do adjusting entry. For example, if you purchase the supplies on account, so you debit your supplies credit account receivable. Until end of the month or the year, you need to make adjustment, right? It depends on how much supplies you have been used. But if you spend cash on it, you do never involve the cash account. You do not need to do adjustment interest. Adjust interest either increase a revenue account or increase expenses account. Okay, that's from our examples already. Now, after you finish your adjusting interest, you need to do adjusting trail balance. The trail balance is prepared after the interest has been journalized and posted, of course. So the adjusted trail balance serves as the basis for preparing of the financial statements. So all those numbers from your adjusted trail balance will go to the financial statements. Remember the orders, we talk about it. You have to prepare your income statement first, right? So all the numbers will come to your income statement first, and then goes to your equity statements, and then go to your balance sheets, and then the cash flow. So I prepare the financial statements from the adjusted trail balance. How do we prepare the financial statements? Following orders, one more time. We'll start with income statements, then we'll finish owner's equity statements, and last is the balance sheets. Now the heading for each of the financial statements. The essential features of all financial statements are the heading of the statements, which including the name, the title, the date or period covered by the statements. Remember, except the balance sheets, the others will be a period, but balance sheets is only be the last day of the accounting period, right? Now the body of the statements varies from statements to statements and depends on the purpose of the statement. The text explains this throughout the two sections under the learning objectives. Income statements. Income statements report profit or loss. So the body including in the income statements is revenue, expenses, right? Statement of owner's equity explains how equity changed in the year. Therefore, the body includes all accounts impacting equity. What are those accounts? My question is net income, okay, and withdrawal, right? So those are closely related to each other, the income statements and the statement of owner's equity. And then the last, balance sheets. The balance sheet reports the financial positions of a company at a specific point in time. So therefore, balance sheets including assets, liabilities account, plus the ending balance from the statements of owner's equity. So we will see, those are examples from our textbook. I would like you to read it through. So that is the one we just talked about it. So the net income will affect your owner's equity statements. So you have to prepare your income statement first, and the net income will goes to add back to your beginning balance of your capital. Okay. And then last annual withdrawals and give you the ending balance. Then the ending balance will goes to the balance sheets of your ending balance of equity, because your assets has to be equal liabilities amount plus your equity amount. Okay. Basic, very basic equation. Ethical considerations. There are always being discussions for ethical considerations in accrual accounting. Only with honest and complete information, including accounting data, can people expect to make wise decisions. Accrual accounting allows for judgment and creates potential for bias and manipulations. Few examples: overstating revenue not yet earned, but we realize that. So that is, so that is overstating your revenue, right? Understating your expenses. So those expenses, deferred expenses to a future period. Those are very easy to make a bias on that, but you do not have to memorize everything for now. Now the last parts is always be the comparison between IFRS and ASEP. For there's no process differences when we deal with adjusting interest. There's no process differences between ASEP and IFRS with respect to adjusting interest. So those under those two rules are adjusting interest are exactly the same. The procedures are exactly the same. Now the learning objective appendix is talk about another way to record prepaid. I'm not going to go through this. If you're interested, you could read on your own through the textbook. So that is for today's lectures for chapter 3. Any questions? Yeah, I know this is kind of, if you are still in trouble to understand chapter 2, to record all those business transactions, this chapter 3 might be a little bit hard to understanding. But please do remember those special accounts we just went through, like the accrued expenses, the salaries, expenses, unearned revenues are very important. So make sure that you understand that. So for the next chapter 4, I think I posted the recording, right? It's a closing balance. So I'm going to talk a little bit more on that. Okay, so that is everything for today. I'm going to post the recording into my Compass. If you have questions, send me an email. You have 1 more month to finish your level 1 study, so you still got time. Okay, and then we're going to go through chapter 5 and 6 next week, and we're going to have a final exam overview on Wednesday. So lectures for next week will be Monday and Wednesday. Yeah, I think so.